Welcome back. Hey, what's up? I'm Russ, and it's time for another thrilling installment of a Dapper Dividends video. Now, before I share my 2024 dividend and option income and the top stock that we're buying heading into 2025, there's something important that the nitpickers always bring up, and that is dividends aren't free. I mean, seriously, whether it's Uncle Sam in the United States, Uncle Jose in Mexico, or Uncle Francois in France, the government will always get its cut. This is just a quick PSA, refresher, and reminder, and I've included a link to a great TurboTax article if you want to do a little bit more in-depth reading. And remember, this is all coming from a guy that is not a tax or investment professional. I'm literally just a blue-collar welder that barely made it out of high school, sharing a passion for passive income, and we are well on our way to a net worth of $1 million. And also linked below, I have a free and fantabulous weekly newsletter where I share all our transactions, a few investing thoughts, and some stocks that are coming up about to go ex-dividend. I understand a lot of people think that dividends are irrelevant or a tax headache, but there are ways that you can reduce or even eliminate paying taxes on dividends altogether. First, if you're keeping your dividend stocks in a Roth IRA, congratulations, you've already paid taxes on the money you contributed and gave Uncle Sam his cut. So all your dividends and their growth are completely tax-free when you withdraw them in retirement, which is the magic of a Roth IRA and why you should have one if it's an available option for you. Now, even in a regular taxable account, you still might be able to pay nothing on qualified dividends like those from Altria Group, ticker MO, or Nike, ticker NKE, but not from REITs like Agree Realty, ticker ADC. And here's how. Looking at 2025, according to that TurboTax article linked below, if you're single with income under $48,350, if you're the head of household making under $64,750, or if you're married and filing jointly and earn under $96,700, you won't owe any taxes on qualified dividends. But I also want you to remember that your dividend income does contribute to reaching those numbers, and that the United States would tax the first dollar after those numbers. $96,700 and first dollar is going to be taxed at 15 or 20%. Now, if your dividends aren't qualified, and shout out to the Motley Fool for this awesome infographic, which means that their ordinary dividends passed through from certain investments, you'll pay taxes at your regular income tax rate between 10 and 37%. That's simply because the company is a pass-through entity and they aren't paying corporate taxes, so you are responsible for that tax bill instead. And don't forget that in traditional IRAs or individual retirement accounts, while you won't pay taxes on dividends year to year, you will eventually pay taxes on everything you withdraw in retirement, because unlike a Roth, you haven't paid Uncle Sam his money yet and he wants his money. Again, this was just a super quick overview of dividends and taxes to remind you that dividends aren't free money raining down on you like a dancer on a Saturday night at one of RCI Hospitality's, ticker RICK, fine establishments reserved for gentlemen only. And again, I'm just a guy on YouTube with some thoughts, sharing my passion for passive income. And speaking of passive income, this is going to be a very, very quick rundown. We can't go in depth on all these because we would be here for 50 minutes, but the dividends we received in 2024, starting with the smallest, ticker YOU, Clear Secure, $1.25, new position for us. Albertsons, ticker ACI, $1.32, ticker SCHG, the Schwab US Large Cap Growth ETF, $1.60. Now, if you want to make money because Tesla goes down in share price, you think they're overdue for a pullback like I do, you can buy something like TSLQ. It's 2 times leverage, so it should go up or down inverse to what Tesla does, about twice as fast. Very, very risky. I have 2 little shares. It's a speculative position I'm going to hold for a couple more weeks. $2.65. They just so happen to pay their annual dividend when I bought them. Diageo, $6.48. If you love Guinness like I do, and you want to own the company that owns Guinness, Diageo would be the way to go. Oh, and by the way, all these in red are no longer stocks that we hold. So you can see there's been a bit of turnover, and we're kind of shifting our focus to looking for companies where their best days are ahead of them. And hey, the stock that we are buying, you could probably make an argument that their best days are behind them. I think they're going to return to greatness, and I'd love to hear your thoughts on that. Ticker ET Energy Transfer 977. Nike $12.21. Duke Energy $15.38. Simon Property Group, the mall company. Hey, if you're near me, if you've been to Pleasant Prairie, Wisconsin, that outlet mall up there, that's a Simon Property Group company, $19.50. Most of you probably remember I held MLPs inside of tax advantaged accounts, which is a no-no because you don't pay taxes on those dividends or the distributions from MLPs until you either sell and then you pay on the gain, or your cost basis hits zero. $30.64 from MLPX, the Global X MLP Energy and Infrastructure ETF. And this pays qualified dividends and pretty much holds all the midstream companies. We like the midstream companies because it doesn't matter what the price of oil is. They make money on the oil moving through their pipelines, the natural gas moving through their infrastructure. So very interesting companies I'd like to own. LyondellBasell, ticker LYB, $38.85. Newer position that ran away from us. Would love to see it back below 300. Will it get there? Who knows at this point, but Visa, we had started this position in 2024, $42.15. Moving along, this is kind of like a high yield savings account. Schwab Value Money Fund, ticker SWVXX, $45.46. If you want to buy a small slice of every single publicly traded US company, you would buy VTI. The Vanguard Total Stock Market ETF hit us with $53.89, and we want this to be a bigger foundational investment in the portfolio and then put more money into those fewer positions that we have high conviction on. McDonald's, $67.80. Innovative Industrial Properties, IIPR, $74.40. Leggett & Platt, $92. They were a dividend king. They cut that dividend. We ended up selling them, held them a little bit longer than we should have, but that's a new rule around here. If the company cuts the dividend, we're dividend growth investors. We're going to cut that company unless they have a damn good reason for cutting or eliminating that dividend. Chevron, ticker CVX, $97.80. Prudential Financial, ticker PRU, $124.80. Lockheed Martin, ticker LMT, $127.50. Brian Nickel came over from Chipotle, kind of mucked everything up. We were nicely accumulating, well on our way to 100 shares in the $70 range. Everybody got excited. The stock shot up at a historic pace in a single day. We're waiting for it starting to come back down. Would love to see it in the 70s again, but Starbucks, $137.64. ExxonMobil, $168.96, ticker XOM. Monthly dividend paying stock, Agree Realty, $181.74. AbbVie, ticker ABBV, $189.10. There's that MLP we sold, ticker EPD, Enterprise Products Partners, $194.88. Good old AT&T, ticker T, which has had one heck of a run right after we sold, which is why it's gone up, I think. $227.01 of dividends. Vici Properties, we're over 300 shares now, ticker VICI, essentially the Las Vegas landlord that you want to own if you want to invest in Sin City. The property at least, $262.58. Altria Group, we sold this earlier in the year. Personal decision. They are a tobacco company and we just didn't want to individually and directly own Altria Group, $303.80 of dividends. We sold TD after the anti-money laundering shenanigans. They got hit with a cap on their future growth in the United States, also a couple $2 billion of fines. We sold Toronto Dominion Bank, ticker TD, $326.01 of dividends. Everybody's favorite dividend growth ETF, SCHD, $484.86. Johnson & Johnson, ticker JNJ, $519.03. Oh, by the way, O is a letter, not a number. When you're in the military and you are physically put into uncomfortable situations like having to do a lot of push-ups for saying O instead of zero. It's just a distinction you're always going to remember. Funny how that works. PepsiCo, ticker PEP, $524. Monthly dividend paying company, ticker O, Realty Income, $612.84. Another monthly payer, Main Street Capital, ticker MAIN, $616.50 of regular dividends and special dividends that they do pay out quite a bit of right now. Our number one individual stock, Nexstar Media Group, $746.98. BDC, Ares Capital, ticker ARCC, the biggest payer in 2024 at $777.60 for a grand tiddly total of $7,138.98 of dividends in 2024. Now flipping on over to the option income that was received from selling covered calls, we've been very opportunistic in this, waiting for those big juicy premium kind of easy scenarios where we don't think we will have the shares called away. But maybe in 2025, I'll start selling some more out of the money ones to get more income rolling in on a consistent basis. But as 2024 saw it, Johnson & Johnson, $82.68 of option income. Altria Group, ticker MO, $97.36 of option income. PepsiCo, $191.02. And then the big mamma jamma, Nexstar Media Group, $789.02. Now with Nexstar, what we've been doing, because if you look at the chart, and this doesn't mean that it's going to continue up or down in this direction, but when it gets to the low 180s, we sell a covered call around 195, 200, and then the price is pulled back to the mid 150s. So it's kind of been in this range for quite some time, bouncing between the mid 150s and the high 180s or the low 180s. But we got a total option income of $1,160.08 in 2024. And when you add those two together, that's a grand total of $8,299.06 of option and dividend income in 2024. And check this out, since moving to Schwab from Robinhood in December of 2019, and after selling $32,000 of some Dividend Kings, stay tuned to the end of the video for that, we've had net contributions of $93,258, which has grown to $150,557 for a total gain of $57,099.08, or about a 61% gain in 5 years. Remember, this is not our full investment net worth. It's just the portion that we share on the channel. Our investment net worth bulk is in a 401k account. We also have ancillary accounts like my wife's Roth, 529s for our daughters, an emergency, and travel funds and the like. So what's that one stock that we're confidently buying heading into 2025? Well, it's Nike, and that is because, first off, Elliott Hill is back. He spent 32 years making Nike great. He retired, and now he's come back to help fix it. They've admitted they lost their way. They focused too much on casual shoes and kind of forgot about the athletes. They're cleaning up inventory by burning it off at a discount, which hurts earnings right now, but it's necessary for growth later. They're rebuilding relationships with retailers that former tech-minded and industry outsider CEO John Donahoe previously abandoned. In the earnings call, they said that they're moving from a push marketing, which is constant discounts, to a pull marketing, which is brand power. And they're just getting back to basics by serving athletes instead of just making fashion statements. Simply Safe Dividends gives Nike the tip-top dividend safety score of 99, very safe. We currently have 63 shares at an average cost of $76.96. So yeah, we're down about 0.7%. Simply Safe put out a note in July of 2024 where they reviewed their situation and they think that yes, these setbacks are temporary, but the dividend remains strong. They grow that dividend fast, 15% 20-year CAGR, 8% raise in November of 2024, and they have a dividend growth streak of 22 years, so they're getting close to being a dividend aristocrat, and that dividend has been paid uninterrupted for 40 years. Now, they did just raise that dividend, annual payout currently $1.60 per share per year. So Simply Safe, based on the 5-year trailing price to earnings ratio, remember their earnings have come down a bit, which has been expected, but it shows that they have an expected price of $53 to $65. But hey, if those earnings start recovering, that's going to go up. and they think they're currently overvalued. But honestly, I think this is a bit of paying a premium for a great global brand. And because those earnings have come down, it's pushed their PE way up. But come on, they were pushing $200 a share when they were in the 170s. They're currently $100 cheaper than that. The dividend yield is 2.09%, which is way above the 5-year average of 1.10%. And look at the sector. The consumer discretionary is 14.3. So yeah, Nike looks very expensive based on that. But as you'll see, the earnings are down right now, which is making that number a little bit skewed. So the free cash flow payout ratio for Nike has jumped up to 62%. And every time that free cash flow drops, remember that free cash flow payout ratio is going to pop like it did in 2020, but that was a black swan year. So I think eventually it will be down below 60 and even 50% when things start to turn around. And there you can see that's why that payout ratio is so high, because it dropped to $2.59 of free cash flow per share, but it's still easily able to cover the dividend currently. And there we see why it was over 100% in 2020, because the free cash flow per share dropped down to 90 cents. And other than that outlier year of 2020, their sales growth is gone negative. And again, we're expecting this, but the market doesn't like it. And they, I think, want to see a couple quarters strung together of positive results, positive numbers from Nike before they start to come back in buying. But I don't know when that's going to be. I think it's a bit of a wave right now. And I guess I'm at the bottom waiting for that wave to come and pick me up. Total sales had plateaued at $51.4 billion, down to $49 billion now. So that could hang there for a little bit. And they're still slowly buying back shares, currently 1.51 billion shares outstanding. Their margins are still very good. 21% return on invested capital. Free cash flow margin 15%. 15 cents of every dollar is making its way to free cash flow. And remember, with that free cash flow, you can pay a dividend, you can buy back shares, carry it as cash on the balance sheet, acquisitions, you can reinvest in the business. So it's a very important and healthy number that they have right now. And what I like about that is they have low debt. Companies that have really high debt, when you have times of turmoil like this, it makes it much harder to withstand, and that dividend could be in jeopardy. But 14% net debt to capital is very, very low for Nike. And their interest coverage ratio, how many dollars of operating income or EBIT, earnings before interest and taxes, do you have to cover every $1 of interest on the debt? $22 currently, $22 of operating income to easily cover every $1 of interest on the debt. This is at finchat.io. I want to show you one number here, which is the ROS, or return on capital employed, which shows how efficiently a company turns its total capital, which is both equity and debt, into profits. So Nike's 22.78% means it generates almost 23 cents of operating profit for every dollar invested in the business. And investors like Pulak Prasad love this metric because it's much harder for companies to manipulate than other profitability ratios. And it gives a true picture of how well management uses all available capital to create value. So that's the stock we're accumulating, couple shares of a week. Gonna do that till we hit 100. We'll see where things are at. We may keep going. I think it's a very strong brand, and it's going to take some time and some patience, but like all things, the market hates uncertainty, and it's probably going to wait until it sees some positive results that it can take to the bank. Now, I'd love it if you would share your number one stock that you're buying heading into 2025, and in this floating little box next to my head, I did sell 2 Dividend Kings. So if you want to find out which ones they are there and a little bit of the method to the madness and what we're doing about it, why we sold them, hey, click this floating little box, and if you do that, I'll tell you all about them there.